Hello and welcome to the HFA webinar Now and Next in Private Equity. My name is Leanne Golding and I am the HFA's Cayman Regional Director. I am a Director of HTC Fiduciary Services Limited and an Officer of the Harbor Trust Company Limited, doing business as Harbor. The HFA is a global nonprofit industry, trade, and nonpartisan organization with a mission to advance transparency, education, and trust in alternative investments. Membership in the HFA includes hedge funds, private equity, venture capital, real estate, and wealth management firms, institutional investors, family offices, and service providers. If you're not already an HFA member, please consider joining today by going to hedgefundassociates.org, which you'll see on the slides. Before we begin, I'd like to acknowledge today's sponsor, Harbor, my firm, and also HFA's annual Thought Leader sponsors, UMB Fund Services and Citron Cooperman. We'll get started shortly. Just to let everyone know, at the end of our panel discussion, we will open it up for audience questions via the GoToWebinar platform. In the control panel, you'll see a box where you can type in your questions and we will monitor it and try to answer them after the main discussion with time permitting. Now let's kick things off and meet our panelists. First up, we have Jennifer Keeney, who is Director of Operational Due Diligence at BNY Mellon Investor Solutions. Gary Smith, a partner at Loeb Smith Attorneys, Cayman. And Gufran Rizvi is COO and partner at HC Global Fund Services. We appreciate your time today. Thank you all for joining and agreeing to be part of this panel today. And let's get started. Today, we'll spend some time talking about recent trends in private equity, alongside a discussion on regulatory preparedness, the allocator perspective, and what we all see on the horizon. Starting off by taking a look at recent trends, the alternative industry continues to grow, with launches of hedge funds and private equity funds showing no significant slowdown. Looking at Cayman-specific statistics, registrations of both hedge funds and private funds continue to grow. The enactment of the Private Funds Act in Cayman recently brought private equity funds under the supervision of the Cayman Islands Monetary Authority and gave a clearer picture of the size of the PE industry in Cayman. Not surprisingly, the size was notable, with over 14,000 private funds now registered. Those private funds cover primarily closed-end PE and venture capital funds. And there still remain over 12,000 more traditional open-ended hedge funds registered with SEMA. Throughout the pandemic, the alternatives industry has successfully pivoted to remote work, virtual roadshows, and ODD being done via Zoom and other platforms, and has not encountered any noticeable slowdown in launches or allocations. Of interest has been the growth in what are commonly referred to as hybrid or crossover funds. As more traditional hedge fund investors seek alpha in the private market, many fund managers are deciding to carve out a portion of their portfolio to invest in these private investments. They typically carry a longer investment horizon, and with that, more limited liquidity. Let's kick off the discussion with some thoughts from the panel on this new hybrid crossover model. And I'll put it to Gary first, just to give us a bit of a description of what they are and how they work.
Thanks, Leanne. Thanks, everyone. A hybrid fund incorporates elements of both an open-ended fund and a closed-ended fund. So typically, an open-ended fund, which all hedge funds are typically open-ended funds, allows an investor to invest for no particular fixed period in time. An investor can redeem or withdraw upon serving notice, and the fund sort of has to undertake valuations at some sort of set periods in order to strike the NAV, in order to allow investors to withdraw. A closed-ended fund, on the other hand, usually does not allow withdrawal rights, so managers don't have the ability to value portfolio positions on an ongoing basis, although in some cases they might still calculate NAV for accounting and reporting purposes. Investors in a closed-ended fund do not typically have the right to withdraw or redeem. And the hybrid is has elements of both those types of funds. And so typically the areas where we've seen it most often in the current market, is where a hedge fund is what starts out as a hedge fund is looking for or is pursuing some sort of opportunistic strategy and is looking to invest in PE. The element of that, or the proportion of that hedge fund strategy or allocation that might be in PE might, for example, spread between 5 to 20, sometimes up to 30%. And so that's in essence what a hybrid fund is. There are other iterations of a hybrid fund. So for example, you could have a private equity fund which is also looking to invest in liquid assets, but we tend to see it most often in the hedge fund looking to invest in private sort of strategies.
Interesting, Gary. Typically, that the illiquid portion is carved out into a side pocket. And I think what's interesting to note is that the term side pocket had a bad reputation if we rewind about 10, 15 years. And it's really had an element of a reemergence as a viable structure and a viable way to make that balance between liquid and illiquid investments work.
I think that's right. I think and there are several factors driving that. So one of the factors driving it is development in certain sectors, right? So we tend to see that hybrid funds tend to focus, for example, in the TMT, specifically in fintech, blockchain technology, where those are growing. Those sectors are growing in a sort of rapid way. And sort of there are great opportunities for sort of special situations type investments. And in that sort of situation, you find that a hedge fund or a hybrid fund starting from the outset is disclosing to investors that, look, this will be part of our strategy, as well as being a hedge fund. We will have we will be pursuing special situations, and so there will be a sort of hybrid element, a closed-ended element to our fund, and that brings up a whole host of disclosure requirements, and also in addition to that sort of close-ended or private equity bit being put in a side pocket. There's also the issue of sort of, you find increasingly in this space, the use of side letters, because typically investors who are willing to participate in that side pocket investment, that illiquid part of the investment, will want to negotiate terms and side letters to avoid some of the downsides which can occur as a result of having your investments, some of your investments in a side pocket in a hedge fund.
Excellent, thanks, Gary. Gafran, what are you seeing on your side of the market? Obviously, you're based in San Francisco, and there is a fair bit of excitement in the PE space, in the pre-IPO space. So how is that factoring into the appeal of these kinds of funds?
Hi. So clearly, a lot of these hybrid funds or crossover funds are happening in a lot of different strategies, but just being in the Bay Area, or if you can call it the tech capital of the world, a lot of these crossover funds are popping up in the TMT and fintech space, right? And that could be a combination of the PM just having a lot of access to companies in the Bay Area that are pre-IPO, and they participate in the pre-IPO placements. And just adding on to Gary's point is, I totally agree how, having sat on both sides of the table, how 10 years ago side pockets and gates were, the big yellow or the red flag. At least the side pockets are now considered the smart thing to do. And what we are seeing is a lot of hedge funds are participating in the privates, and also a lot of the private funds are keeping a lot of these positions on their books post the IPO. So that's why we're seeing hybrid funds on both ends. And also, as we all know, in the public equity space, it's getting so competitive, and the assets under management has gone up to trillions, and the number of hedge funds, I've lost count, like how many, 14,000 or what they are right now. So these funds really get to differentiate themselves. And what I call is they get the nitro boost if they have some of these private deals, whether it's a Snowflake or Airbnb or whatever these names are. And the strike ratio doesn't need to be like a VC fund where your goal is to get 2 out of 10 right. Over here, it's more than, I'm just throwing out a round number, it's more than a 75% hit rate. So seeing a lot more of that, and also we can talk about that later, how the IPO market has changed, and a lot more of the pre-IPO placements are happening as compared to before.
Thanks, Gafran. That's excellent sort of market intel, and I'm sure beneficial to everyone listening. Jennifer, looking from your point of view as on the ODD and the allocator side, what sort of opportunities does a hybrid fund offer that might be a little bit different than a traditional PE fund, or how do you see it from your side? I know you focus primarily on PE, but we are seeing some of these hybrid funds sneak into the realm of what you're looking at.
Sure. So the opportunities, there are opportunities from the sponsor side and also on the investor side. From the sponsor side, it really allows them to invest in liquid and illiquid investments, as Gary said, and the sponsor benefits from multi-year commitments that lock up investor capital for a longer period of time. So where in the venture capital space, capital is locked up for 8 to 10 years. In traditional PE, it's 3 to 5 years. What we're seeing in the hybrid space, the capital is locked up for about 1 to 3 years. And on the investor side, it allows investors to redeem their capital at specified times, and it allows new and existing investors to add capital on an ongoing basis, which is prohibited in the typical closed-end structure. So we're seeing revised terms in the governing documents. This would include redemption notices and the frequency of redemptions. Typically, we see about quarterly with 90 days notice or quarterly with 180 days notice for the less liquid funds. And the notice period is important for the fund managers because that allows them to see the fund or the flow and the pipeline of redemptions. There's also different types of lockups that we're seeing, and that makes sure that investors are committing to this strategy often in return for lower fees. So we're seeing rolling lockups. We're seeing soft lockups where investors can pay to get out of the fund if the fund is liquid enough, and there are hard lockups, which is more appropriate when there's genuine illiquidity in the portfolio. So there are clear differences between all of those. Other mechanisms are gates, and that limits the amount of redemptions coming out of the fund. And the purpose is to slow down the amount of redemptions. And we're seeing, 2 different types of gates. There's the fund level gates where they're limiting redemptions coming out of the fund as a whole. And fund level gates were criticized in the global financial crisis because people were putting in standing redemption requests, forcing runs on funds, and people didn't want to be left holding the illiquid assets. The investor level gates, I believe, is more investor friendly, and that is what is limiting the amount that investors can redeem.
With all that sort of setting the stage of what these hybrid funds offer, are they attracting a different subset of alternative investors? I don't know if Gafran, the types of investors you're seeing that are attracted to this structure and this strategy.
So I would say yes, right? Because as soon as you go from your traditional hedge fund to the crossover, you do attract a different bucket. Most of these allocators, you might think they're, Jennifer can add to this, is you might think they're going after a single manager, right? That is actually a rare event unless they really want to invest in that manager. So they generally have buckets. You have the liquid bucket, you have the illiquid bucket, you have the real estate, treasury. So when you have hybrid or crossover funds, a lot of these allocators now can allocate from 2 buckets, right? And the other thing that we've also seen, maybe more in maybe in Austin, Texas, and San Francisco Bay Area, or Seattle, or even Boston, is a lot of the LPs or family offices are participating in these because they've had exposure to these firms. Either they've been part of IPOs that have done well, and they are sitting on a whole bunch of cash, or they know these names pretty well, right? So that has opened another tranche of LPs who are all of a sudden invested in these hybrid funds. And then another thing that we've seen is on the institutional side, I'm just using examples. Suppose it's a $300 million fund and the institution has 10 million with the manager. And if these managers are participating in a private deal and they're allocating it to the main fund, and they're also setting up SPVs, which we would love to talk about a little more on SPVs, we have seen some of these institutional guys allocate more to the SPVs than their original size of the allocation in the main fund. So yes, for sure, it's been a big attraction for different kind of LPs because the managers like it too. This helps them differentiate it, and the LPs, who know some of these names well, whether it's, and like the names from last year, I'm not going to take any current deals that are happening, whether it's, the DoorDash or the, Airbnb or the Snowflakes. Yes, it's a big attraction. We're seeing a lot more non-traditional hedge fund allocators allocating to crossover funds.
Yeah. Go ahead, Gary.
I was going to say, I would add also that in terms of from an offshore perspective, so Cayman and BVI, the sort of expansion of the regulatory landscape in the offshore world has actually helped in terms of investor, especially institutional investors' confidence, because now what we have in Cayman and the BVI is a sort of increase in terms of an increase of the requirements that need to be put in place for offshore funds. So Cayman, still has the advantages of being completely tax neutral in terms of these funds. In terms of structuring, it still has all the flexible structuring options available, but the framework on which these funds operate without being burdensome has expanded. And so we've seen, especially 2 years ago, it was thought that this increase in regulation or this regulatory framework would put investors off, but in fact it's actually enhanced it, because there are so many more sort of checks that are put in place to give investors the ability, and for example, the type of things that Jennifer would do on the ODD side to sort of check that these requirements are in place. And so that's actually helped institutional investor confidence as well. And that's also led to an increase in hybrid funds being set up, especially for where US tax exempt investors are part of the structure or are being targeted, or where part of the strategy is to actually target non-US investors as well.
Excellent. I think, Gufran, I definitely want to come back to your point on the SPVs, and maybe we can talk about that a little bit later when we're talking about some of the allocation topics. But given you've introduced the subject, Gary, if we pivot back to a more traditional PE, if someone is looking to consider setting up a PE fund in Cayman, what do they need to put in place to make sure they meet these new regulatory requirements that you just touched on, both the statutory and then the best practice? And then I think we can pull in some of the other panelists to talk about the best practice side, but it'd be great to hear from you on sort of the nuts and bolts of what they need to ensure they have there.
So from a Cayman or BVI perspective, for private equity funds and VC funds, they're now governed by new private funds legislation in each jurisdiction. And some of the key requirements are most closed-ended funds, and by most I mean the overwhelming majority, have to be regulated in the offshore world, in Cayman and BVI. So they're registered with the regulator. They have to do annual audits. There are valuation requirements for these closed-ended funds, with a valuation frequency requirement of at least a valuation taking place at least once per year, or at sort of greater frequency depending on the sort of the status of the asset portfolio in the fund. They have to have a sort of independent custodian that's providing custody for the assets, unless it's sort of not appropriate for the fund to take on that requirement, simply because of the makeup of or the size of the fund, or the makeup of its assets. There's also a sort of requirement to keep fund assets segregated, separate from some of the things that we used to see in the past, where you would find, for example, you're doing sort of investor due diligence on a private equity fund, and the GP says that some of the assets are or the bank account is held in the name of a separate company, because for whatever reason they couldn't open a bank account in the name of the fund. Those type of things are just not. There are requirements which sort of outlaw those types of activities. So there's a new cash monitoring policy, which means that cash flows, inflows from investors coming into the fund have to be monitored on either typically by an independent service provider. The most appropriate in most cases would be the administrator, and the auditor typically at the end of the year is required to do title verification. So that gives investors comfort that the assets which the fund is supposed to have acquired, there's someone there verifying that at the end of the year, and typically that's the auditor that will do that. There are also sort of what we call AML KYC compliance requirements, which were always there, but the focus on them has increased because the regulators in both jurisdictions have placed increased focus and monitoring of compliance of AML requirements. And so AML officers, we see, for example, the Monetary Authority here in Cayman reaching out to us as Cayman Council to ask, for example, who are the AML, can you please supply a copy of the AML compliance manual for the fund to check whether or not it's up to date. The regulator needs details of the AML officers of the fund. So all these requirements are being increasingly sort of policed, if you like, by the regulators, and so that adds to the focus on compliance. And all of these things is sort of as a package has become a sort of great benefit to especially institutional investors when investor DD is being done on either new funds because they're seeding them, or existing funds for investments.
That's all. I think what I see as sort of a trend is more institutionalization of this portion of the market. And I think there are benefits to all. As you said, Gary, there wasn't a downturn in the number of funds. In fact, it's probably attracting more funds to this jurisdiction. I mean, noting that there are still a tremendous portion of PE that is onshore, that is based in US Delaware type structures. One of the aspects of the increased regulatory sort of overlay is the increasing use of third-party administrators. Gufran, what have you seen from your perspective at HC Global on the shifts and the trends of PE firms using third parties?
A lot more, right? So again, not to sound like a plug, it might be one. We're seeing a lot more of the private funds doing fund administrators, and Jennifer, you and I were talking about it last week. And one of the reasons is I think the ODD and the allocators like it too. They like someone who has a separate set of books and records. It's not being done internally. one of the reasons we found why, a lot of our business initially when we started, or even just going back 5 to 6 years ago, around 90% of our clients were hedge funds, and now it's almost 50-50 because a lot of the hedge funds are doing crossovers, and a lot of the privates are also now keeping post-IPO positions. So we did, especially in the Bay Area and maybe Jennifer in New York too, it is hard to find talent, and especially when you have crossover funds and you need expertise on the public and the private side. It's getting hard to find talent, and then the ODD guys like it, the allocators like it. It's easier to set up. And I was talking to another manager, I think Leanne, you and I know that one, a couple of weeks ago. It's really hard to set up an infrastructure on day one for a crossover fund. So yes, for managers who've been doing it for 5 and 10 years, slowly start doing this, but it's really hard to do it on day one. So the easy solution is, outsource it. So let the fund administrator take care of it. You have the expertise. You can tap into the private side, the public side. And as Gary was mentioning, a lot of tax questions will come up. So you can make sure you structure it correctly and you can scale, right? So they don't need to worry about, is this a $100 million fund or 200, 500 going up to $1 billion? And we will get to SPVs, but we all know when it comes to SPVs, no one does one. It's always SPV 1, 2, 3, 4, 5. So the scaling, so the clients also like it. It's easier to scale up or even down when you're just using a third-party administrator, right? And one of the things I think Jennifer would love to hear your thoughts is, if you are using a fund administrator, it becomes a fund expense. And if you are doing it internally, you can allocate it to the fund. I think it sounds a little grayish, but it's a management company expense. So that's another advantage to the managers, is let the fund administrator do everything, then it's all a fund expense, right? And the key thing is just make sure they allocate the expenses correctly.
Yeah, Jennifer, do you have anything to add from sort of this, the regulatory and statutory best practice side?
Sure. So cash controls and regulatory compliance, the segregation of assets and valuation policies, these are all areas of focus for ODD. We have seen some funds choose not to domicile in Cayman because of the private funds law, and that then causes us to take a closer look at the back office operations of the fund. Administrators are less common in private equity funds that we've reviewed. So in our opinion, having an administrator really adds credibility to the organization and control and transparency and the review of the activities. Mm-hmm. So when these activities are conducted internally rather than outsourced, it can potentially increase operational issues.
Sure. And I think that it's been a good thing to see that the regulatory overlay has matured and benefited the industry overall, and it's not just seen as a regulatory creep that's getting in everyone's way, but that there are actually benefits to it. One of the things that I'm seeing from the director, from the governance side, is traditional PE funds, for the most part, were structured as a limited partnership. So the general partner basically oversees both the portfolio side and the operational side, and there's no independent oversight of those operations. And we have seen a renewed interest and a growing interest in there being advisory committees established. And I would caveat that with that an advisory committee is separate in its focus and its mandate than the traditional LPAC, which is usually comprised of key investors in the LP that want to have a seat at the table when discussing some of the deals that the PE fund will invest in and that sort of thing, and also having some involvement in conflicts and allocations and things. But we're seeing some interest in that, and I'd love to, if anyone has any thoughts on sort of with the more institutional investor appetite for these PE and crossover hybrid funds, you know, is there going to be more interest in that independent oversight and the benefits that having someone to look at, overlay and overlook the fund structure to ensure that everyone's doing what they're supposed to do and deal with any conflicts. Jennifer, I don't know if you have any thoughts on that from the allocator perspective, whether you're seeing that or whether it's something that investors are looking for, or if it's still early days.
We're looking for independence, not only, you know, with the fund administrators, but even internal committees such as the Valuation Committee. We're looking to see that there are representatives on the Valuation Committee that are not just investment team members or people working on deal execution. So we're looking for people such as, you know, people on operations or compliance who can review the valuations and provide that independence. You know, also getting their auditor, you know, at year end to, you know, sometimes auditors have different teams, so having a separate team from opine on the valuation methodology is something that we also look for as well.
Yeah, it's interesting, and I think it's, sorry, Gufran, did you have something you wanted to add on that?
Yeah, jump on a question for Jennifer. So on the valuation part, you know, with your ODD cap on, do you prefer a third-party valuation company or a provider, or are you okay with the PMs doing the valuation?
We mainly see the PMs doing the valuation because they say that they're more adequately performed to provide this information. And we're seeing the administrators are not independently conducting their valuations, but they're just documenting them. We don't see a lot of third-party valuation firms get involved with that, but if they are involved, it certainly works to their benefit.
Mm-hmm. And I think I've seen it from my side as a director, and it's in the crossover hybrid funds where the audit team that is working on that fund is primarily Hedge, and if there is a private portion of the portfolio, we have encouraged those firms to engage a third-party valuation agent for that portion of the portfolio, because it does assist with the audit process and gives the auditor a bit more data to go on when they're verifying the valuation of that portion of the portfolio. It does vary by audit firm, because some audit firms have a very robust and large valuation team, whether it's in the location of the audit or through their global network. But there are instances where it can avoid a discussion at a late stage of the audit on a valuation piece that could end up leading to a qualification of the audit, whereas if you engage a third-party valuation agent early on, that can sort of cut that off at the pass and make sure that issue doesn't grow into more than it needs to be. Shifting a bit to the allocator's perspective. Oh, sorry, Gufran, did you have something to add there?
Keep interrupting you, my apologies.
No, that's fine.
Yeah, no, so we are seeing a push from some of the financial institutions and a lot of the fund-to-funds asking our clients to bring in a third-party valuation company, and that's why I was asking Jennifer, you know, what are you looking at, and what do you prefer from your end, right?
Right. We see it more on the hedge fund side rather than the private equity funds that we're reviewing.
Yeah, and that would make sense. Where I'm seeing it is on those ones that have the crossover between the two. Putting on, you know, going to you, Jennifer, as the ODD expert on the panel, you know, when you're evaluating the operations of a PE or hybrid fund, what constitutes a red flag in today's market? I mean, the term red flag gets thrown around a lot, and I would imagine it evolves over time. So I'd love to hear your thoughts on that, and we'd love to hear about your 4 pillars that we discussed in planning, that we all really grabbed onto the concept and see a lot of value in looking at things through that lens.
Sure. Red flags, the more common operational risk relate to valuation and conflicts of interest and compliance and reputational issues, either with the service providers or background checks on key principles involved with the fund. You know, examples of some of these red flags would be weak cash controls or weak deal execution process with the operations team and wire transfers. Key person risk, that's something that we see with private equity firms right now that are facing generational succession issues. History of regulatory filings, qualified financial statements, the list can, go on and on. But just because a red flag is identified, it's not an automatic deal breaker. It's usually a combination of issues of a manager who is unwilling to incorporate changes or our recommendations, and that would be a larger red flag and give us pause for consideration. We build a picture with that manager. So identifying these weaknesses is really why operational due diligence should be conducted on these types of funds, and it's to ensure that mitigating processes are established and whether there are any mitigating factors and how the firm addresses them. The four pillars.
Yeah, go ahead. Yeah.
The four pillars. We approach ODD with a philosophy of four pillars, and that's transparency, consistency, infrastructure, and manager reputation. And all the investment managers and firms need to pass these pillars in order to achieve a rating. And by transparency, I'm not referring to the same information that's provided to the manager research or investment team that is looking at the fund. We're not looking for the portfolio construction models and theses. We're looking for transparency into how the manager is running their business and how they're running their operations, transparency to give us their contacts for the service providers who they're aligning with. If a manager is not giving us transparency, then we really can't do our job and proceed with the operational due diligence. Consistency refers to once we've received that transparency from the manager, we are comparing the documents to the fund formation documents and to the policies and procedures. We're comparing it to the conversations that we're having with the key principals about the deal execution process, for example, or about cash controls and wire transfers. We're comparing it to what we're hearing from their service providers as well. And if there's any inconsistency that indicates some type of change and causes us to look closer at that particular area. And the infrastructure and operations that refers to us either going on site or virtually seeing what systems that they're using for trading or portfolio oversight and whether they're applicable to the strategy and how they use them. Some managers have touted that they have state-of-the-art systems, and then when you ask them how they're doing things, they pull up an Excel spreadsheet. So that's what we're looking for there. And finally, with reputation, we have to be aware of any headline risk associated with the fund manager, key principals, and the service providers.
Mm-hmm. When you're looking at compliance, obviously compliance is a big part of infrastructure. And as Gufran mentioned earlier, launching a fund, there's a lot of infrastructure you need to either have in-house or outsource. What are your thoughts on compliance programs, and in particular, who's the right person to wear that CCO hat?
Well, that's interesting. There was a November 2021 risk alert, I believe, by the SEC about, actually it was November 20, and it was about dual-hatted CCOs. And this risk alert highlighted the importance of having a dedicated chief compliance officer at the firm, because those that wear multiple hats can be distracted, and those tend to lean or end up with exams with deficiencies and weaknesses. So we're looking for, from an overall compliance program, to see how the manager is operating in a highly regulated environment, the team that they have in place, how they're monitoring personal trading, how they're looking at conflicts of interest, whether they have an outsourced CCO, and what type of support that they're getting from them. But overall, the responsibility has to be with someone at the management company.
Right. I think from my director perspective, I always prefer it when the CCO is in-house, appreciating that, if a fund launches with 4 employees, you're going to have difficulty finding someone to be the CCO that doesn't wear another hat at the same time. So there are challenges, especially on the emerging manager space in that area. Cybersecurity is a huge topic, so I'm conscious of time and don't want to get into too much detail, but obviously that is something that you look at, Jennifer, when you're doing your review, and hopefully having firms like Gouffran's in place or other service providers that can help mitigate any concerns in that area, I would hope.
Yes. So COVID has obviously forced all firms, or most of them, to shift to a work from home operating model, and there's increased cyber risk and attacks on infrastructure. So what we're looking for is that there is a cybersecurity policy, protocols and procedures to protect data and intellectual property from unauthorized access, either internally or externally with the firm. So multi-factor authentication, penetration tests, vulnerability scans, access control, incident response planning. Those are all things that we're looking for. Security awareness is very important. So having social engineering and phishing tests to monitor unusual behavior is also important, and remind people that the policies still exist and they still apply in this remote environment. And we're also asking investment advisors in the private equity space how they're evaluating the portfolio companies that they're investing in as well. So I think the best practice would be to engage their outsourced consultants if they use one, or an internal team, and bring them in to evaluate the portfolio company's infrastructure. It's viewed as an extension of what the private equity team is doing.
Sure, great. I mean, a lot to consider, a lot for all of these managers to stay on top of. Circling back to a topic we touched on earlier, Gouffran, in relation to SPVs, and just to give a bit of context to the audience, that in a lot of cases, a hybrid fund or a crossover fund will have a portion of the main portfolio that is invested into these private, more liquids. But often there's a standalone SPV created for particular deals, and as you said, there can be multiple of them. What are some of the challenges or the things that managers need to stay on top of when they're using that kind of structure? And I'm, as you can tell, I'm kind of leading towards the allocations and expense side of things. What are you seeing being done on that, in that space?
If I could just rewind back 30 seconds. So one on the points with Jennifer is, so Jennifer, I think, back to cybersecurity, which again is a tricky one, right? If it's going to happen, it can happen to anyone. So the best thing to do is, put in the best practices, lock in as much as you can, and test as much as you can, and also training. I think training is the most important thing. Talk to the employees, tell them it's, what they're supposed to do when stuff goes wrong, right? But also, recently we have seen in the last 3 to 5 years where the IT providers, outsourced IT providers, are playing a bigger part, right? So in a way, it helps that you don't need to worry about a lot of this stuff. But with an outsourced model, now most managers have more counterparties than they did 5 or 10 years ago, right? So there are more gates to be closed. But the good part is there are more professionals and experts, standing at the gate, right?
Yeah.
So back to the SPVs, right? Yeah. So the whole IPO process that I see is, as you know, in the old days, it was all the big hedge funds, the IPO was to happen, right? So all the big hedge funds, depending on their size and, AUM and the size of the client, the big bankers gave them allocations, right? The $5 and $10 billion funds got all the allocations, the $200-300 million funds got peanuts. But now, I think we spoke about this a little bit before, the game has changed. A lot of these allocations happen on the relationships and the work the manager has done with these companies during the private days, right? So what ends up happening is a lot of the emerging or the mid-size or the smaller hedge funds, whatever you might call them, end up getting a decent size of allocation. So suppose I'm using round numbers, right? Suppose it's a $250 million fund. And as Gary was mentioning, the capacity is only 20% can go in privates, right? And they've already reached the capacity. So what they'll do is they'll put 25 million in the main fund and then come up with SPVs. And SPV 1, 2, 3 for each deal. And that's where the allocation policy and the expense policy becomes very important, because now that one private deal is going into the main fund and it's also going into SPV, right?
Yep.
And sorry, oh, I thought someone was saying something. So that's why it's very important to have the right allocation policy, because you can either have multiple funds and multiple SPVs, right? And you can, what we also see sometimes is managers will participate in different rounds. So they've done SPV 2, and by the time they get to SPV 6, they're going to do the next round of the same company, right? So it's very important to have the right expense policies and the right allocation policies. And that's why we try, even just being the fund admin, we try to have conversations before these things go live. And that's why we tell our managers, keep us in the loop, because I know most of the private deals don't happen overnight, right? Gone are the days where there's a roadshow, you go and meet the IPO company, you come back to the trading floor and you put in the allocation. All these things take 3 to 6 months. So, communicate, let's talk to the council, let's talk to the directors, let's even talk to the allocators. And one of the tricky part is, I would love to hear Gary and Jennifer's thoughts, is on dead deals, right? You've done a lot of work, you don't get the allocation, right? Or the deal just falls apart, then what do you do with all your expenses? And if you have SPV 1, 2, and 3, are the old funds participating in the new deal, right? And then how do you allocate the expenses for the old funds? Because what happens is the new funds will have all the right language, but some of the older funds, even if they're not Jurassic, right, they're just like from 3 or 5 years ago, right, the language will be different. So that's why we like to have really well-defined, it's all about disclosure.
All about disclosure.
The documents, so the LPs are happy, the directors are happy, the auditors are happy, and you might decide not to do it, right? Some people throw in travel, some people throw in a lot of other stuff, right? So as long as you've disclosed it, that's the most important thing.
I agree with that. I think disclosures, especially in the case of hybrid funds, it's a key part of the it's a key part of the pathway towards getting to the stage where the fund is launched. It's not enough to say, for example, that we may invest in sort of special investments from time to time. If the intention is for it to have, for example, a 20% allocation towards illiquids, then it should be. Sometimes managers have the challenge of, I'm starting out trying to launch a hedge fund, but how do I sell this, this 20% illiquid part of it, which is what I want to pursue, because a roadshow might have shown, for example, that the vast majority of potential investors are interested in a hedge fund, but they're not necessarily sort of enamored by investing in illiquid assets. And so the temptation at that point might be sort of in the offering document to downplay, sort of the illiquid element of the whole thing, so that you for example, start having language like we may from time to time acquire illiquid investments, when in fact that's it's a smaller part of the allocation, but it's a key part of the overall strategy of the fund, which makes it a hybrid fund. And on the Cayman requirements, that sort of key element would have to come out sort of properly disclosed in the offering document, not just in terms of we will be this part of this overall strategy, it will be invested in PE, for example, but more in terms of some of the digging further into the detail. For example, the valuation strategy. When will, for example, how do we deal with cost? Do we carry all investments in the liquid portfolio at cost, or do we carry it at some other value? Do we, for example, Do we make periodic distributions out of that side pocket, or do we sort of keep everything until realization? All of those types of essential detail, should be in the segment that deals with the illiquid portfolio, because it's actually a good thing for managers to do that, because it actually, one, you have investors who are coming in sort of with their eyes wide open to the offering, but also it also protects you in terms of potential legal action for misrepresentation and that sort of thing on the downside as well.
Mm-hmm. Well, that's good advice, and I think.
Sorry,
go ahead, Jennifer.
I agree with what both of you are saying. Just with Gufran, having the disclosure about these policies is very important, and with Gary and with the offering memorandum has that language saying that they may invest in illiquid investments, and that prompts us to ask them about the policies that they're going to have in place on how they're going to value those and issues of allocation.
Yeah, and sort of bringing back together both the language that you'd want to have in a PPM that just has a side, a section that's illiquid, and then also the SPVs. You'd want to make sure the same disclosure is there if you have standalone SPVs for specific deals. So it comes down to sort of the buyer beware. Make sure you lay it all out there of what your intentions are and what could be expensed back to that particular segment of the portfolio, so that there aren't any surprises. As a director, my one advice when I take on a new client is please no surprises. If anything's coming up, please tell me. And the same thing from a document perspective is please lay it all out for me. And I think we've seen an evolution of that over time. The expense portion of an offering document used to be pretty brief but pretty broad. And I'm now seeing them be very broad and very detailed. So it's laying out exactly what can be charged back and what to expect to coming out as a fund expense. Conscious of time and that it's hard to believe we only have 5 minutes left. I'd love to just sort of wrap it up with each of the speakers, just your thoughts on what's on the horizon, because we are talking now and next. So what do you see happening in this space, in the next little bit? And I'll give you each a minute or two to sort of give your brief thoughts on things you're excited about or things you expect to see coming down the pipeline. Gufran, do you want to go first?
Sure, yeah. So, I think you started the whole webinar by saying, how the last 2 years have turned out. A lot of launches. It's like, you have the pandemic on one side, and then you have the markets on the other side, right? So I think we're going to be seeing a lot more of the hybrid of the crossovers, right? Because that has helped the managers differentiate themselves, right? The SPV stuff, I think more of the SPVs are going to happen, and there's a whole blend of the privates becoming hybrids and and the public equity hedge funds becoming crossovers too. The outsource model is going to happen more and more, which makes it easier for managers to launch and grow and scale. So I'm, clearly a biased opinion, but not bullish on the stock exchange, but bullish on the market, right, or the industry, right?
Excellent, thanks, Gufran. Gary, what about you?
So I think, especially for US managers, as the blockchain technology space expands, I think there's an opportunity there for non-US investors to be attracted to offshore funds, feeding into, for example, either a sort of US master fund or even an offshore master fund. So I think the expansion of sort of the technology space in a broad sense, it creates more opportunities for master feeder structures, whereby you have sort of non-US investors coming into offshore vehicles with a US manager managing onshore, US fund and an offshore in a sort of master feeder structure. The other trend that I see popping up is sort of also linked to blockchain technology, which is more hybrid, not in the sense that we've been discussing, but sort of in the sense of the asset class. So I expect to see more PE funds, for example, issuing tokens rather than LP interest, for example. I think that's, or even creating as a sort of a different element to the hybrid structure, creating sort of maybe secondary markets where units or LP interest or tokens can be exchanged as part of a traditional PE fund, but adding a sort of element of liquidity in terms of the ability to transfer interest. We've seen that popping up this year, and I expect that it will continue into next year.
Thanks, Gary. And Jennifer?
Yeah, I think digital assets are gaining wide attention, so I would expect to see more increased exposure here. From an ODD perspective, there are some unique challenges with this. The service providers are different. We're not seeing the typical custodian names that we would normally see. So trading solutions and infrastructure is different. Custody and valuation, those are all areas that require a lot of a different angle of scrutiny. So that's my expectation.
Excellent. I mean, I think those are all things that are on the horizon from the governance side of wanting to keep an eye out for. And I'll look to you all to provide the right structure and the right landscape for this. And as the director, we'll keep our eyes on it and see what comes across our desks. Thank you very much to my entire panel and to all of you for attending today's HFA webinar. You will all the attendees will receive a follow-up email, which will include a replay of the webinar and the ways that you can get in touch with all four of us. So thank you again for joining. We wish everyone to have a wonderful holiday season and have a great afternoon. Thank you.
Thank you.
Thank you.
Thanks, everyone. Thanks.
Thanks, guys. Thank you.